Are private equity and similar illiquid types of investments a ticking time bomb for your pension check? We'll talk about that on the program. Plus, talk a little bit about the economic impact that Hurricane Ian had, much far beyond the tragedy and the incredible shock of that storm, along with the tremendous loss of life. As you might well imagine, those storms have an economic impact. So we're going to talk about that as well here on the program. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of that team, thanks to Rob Field and Garrett Fields of our office, also fellow certified financial fiduciaries, for taking the reins of the program last week, certainly marking the start of the fourth quarter. And at least for the first few days of this past week, they were taking accountability for having done such a great show that the markets responded so strongly on Monday and Tuesday. In fact, that Monday and Tuesday was nearly a 6% increase, the biggest two-day increase in a couple of years or so, since April of 2020. We'll talk more about that on the program, because we thought we would today share some of our sentiments that we put in that beginning of fourth quarter communication that we sent out to our clients on Monday. Clearly, volatility still reigns as the battle that we've described for many months now on this program between inflation and interest rates continues to sort of move markets and move everything else as well. Earlier in the week, that Monday and Tuesday that we were referring to, there was sort of a mounting sort of thought that perhaps based upon the data, based upon the impact, that there might not be quite as aggressive interest rate increases going forward. And that mere sort of suggestion, or I guess change in perspective, really helped to kind of spur the markets. It's funny, as we were talking about in the communication to our clients that we sent out on Monday, the third quarter really did sort of provide a microcosm of the markets versus interest rates, right? During the first part of the third quarter, there was about a 14% run-up from July 1 to about mid-August, in anticipation that maybe they weren't going to have to continue to raise interest rates quite so much or at the pace that they were raising. And then lo and behold, that sentiment changed. Jerome Powell, the chairman of the Federal Reserve, did a lot to change that sentiment in some of the speeches that he gave in mid-August, particularly the one out at Jackson Hole, Wyoming. And that changed sentiment for the markets. Markets basically came to the conclusion, okay, wait a minute, they are going to raise rates, and they are going to be raising them at a pretty good clip. They are committed to that. And then, so consequently, you saw the market swing downward by about 16%, leaving the third quarter slightly down if you measure the period from July 1 to the end of September. Now, the reality is that that's the very definition of volatility, right? Volatility has always two parts. We often think that volatility only has the down piece, but oftentimes what you find if you parse through history is some of the very best days in the market are in fact clustered around some of the very worst. Hence, we have Monday and Tuesday where you had a big, almost a 6% increase just in those 2 days. I guess, though, bad news is that's a little consolation for a market that still remains about 20% down from the beginning of the year. And through the first three quarters, the markets had logged their worst performance for the first 9 months since 2002. So certainly not a particularly great setup for 2002, going into the final quarter, if you will, of the year. And certainly, as we said in our email that we sent out to folks on Monday here at the start of the fourth quarter, a hurricane, I guess, is a fitting end to that third quarter that saw a big run-up and then a big decline, and then the start this week, a decent run-up. What's happening out there, and there's two sort of pieces that we want folks to sort of appreciate in terms of timing and kind of looking forward, because there's a couple of things that are sort of in the soup but take a while to get there. The first and foremost is the Federal Reserve rate cuts. So the Federal Reserve rate cuts typically take 6 to 9 months before they'll work their way into the economy. Well, if it's just September, well, now it's October, and the first cut was in March, then you're just beginning to see the implications of that first interest rate increase. I said cut earlier. Increase, I meant wishful thinking, right? On the to get an interest rate cut these days. But that first increase is just working itself into the economic system. Meanwhile, if you think about the markets have a history of traditionally sort of looking ahead and pricing in the world that exists 6 to 9 months from now. So if you kind of put those two together, it helps to get some perspective on the market kind of looking out over the next 6 to 9 months, particularly during the month of September, and saying, okay, well, you're going to have a bunch of these interest rate increases really start to have that impact over the course of the next several months. And if you think about that and understand sort of those time frames, at some point going through the third quarter, the first 9 months of the year, market's down 24%. Does that maybe price in a current or near future recession? At some point, that starts to get priced into the markets based upon how the markets have performed. Now, probably not all of that notion of a potential recession has been priced into the markets, but probably a pretty healthy dose when you think about it being down 24%. And so that was sort of one of the things that we referenced in our email that we sent out to folks at the beginning of the week. Also included some conversation about the presentation that we did 2 or 3 weeks ago to our clients, brought in a speaker to talk about some of the larger picture items. And so I wanted to take a moment and just read a couple of sentences, if you will, from some correspondence of someone who heads up one of the largest money managers, one of the largest institutional money managers in the world. And so here is sort of what he said that we sent out to our clients. I think it sums it up relatively well. And so he says, despite these challenges, I remain optimistic about the investing environment for several reasons. First, there are still signs of growth as the global economy recovers from a pandemic. Second, corporate earnings will be the driving force going forward. And third, experiencing a healthy recession in the next year or two, for all of those concerns above, that moderate recession is necessary to sort of clean things out. You can't have a sustained period of growth without an occasional downturn to balance things out. With that, we will return and have some additional thoughts and comments here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Reading some comments in that last segment at the end from one of the leaders of one of the largest institutional money managers in the world. And I want to just recap that last sentence that we were saying before the break. These are his words, not mine, but obviously we echo the same sentiments. A recession is necessary to clean out the excesses of the past decade. You can't have a sustained period of growth with an occasional downturn. It's part of the economic cycle that's been going on for 100 years to balance things out. It's normal, it's expected, it's healthy. Now, what's it mean for investors? Well, it's impossible to predict because of how that cycle moves and moves very quickly. So there's no way to really time it, but the better approach is to participate in maintaining a balanced, well-diversified, all-weather portfolio. The kinds of stuff that we've been talking about on this program for 30-odd years. And through that, we've seen how many recessions? 4, I think, if we go back 30 years. So it's a formula that kind of works. On the positive note, though, we've got some interesting stats that we want to share with you, as we did at the beginning of the week with our clients, that might help to give some perspective on that. And I think the first one is what we were saying a little bit in the last break. Look, if the market's down 24%, what do you think that's priced in? Has it priced in maybe already a recession? Maybe it's saying, hey, we're already in a recession. One could argue that with 2 quarters in a row of negative GDP growth at the beginning of the year, Q1, Q2 of this year. Or is there one immediately around the corner? Who knows? Clearly, if the market's down 24%, it's priced in something already. And I guess that's the key point. A lot of people, when you go through a period of time like this, say, it's going to just keep going down. There's not going to be an end. And that's not how it works. Because eventually the market sees, okay, the next part of the cycle, which is the recovery part, and says, all right, well, we'll start kind of moving up here. And the thing that people forget is that concept we were talking about in the last segment. The market's looking out 6 to 9 months. So if you're looking at today's headlines, guess what? Market's already kind of priced that in already. What does the future look out 6 to 9 months? Okay, well, you've got all those interest rate increases that have now had their impact, and in theory, they've had that impact on inflation. And so perhaps now, thinking 6 to 9 months, okay, maybe the Federal Reserve can kind of pull back a little bit on its approach. Of course, stay tuned on that. That's why we do the show every week, because the markets change every week. But we want to leave you with sort of 3 other sort of stats, if you will, in this conversation. And the first one is one of the ones, well, all of them are ones that we pointed out to folks in that communication that we sent out on Monday. The reality is that there's a kind of a misnomer that when you have rising rates, that it's not a good period of time for market performance. And not to say that it's a great period of time, because obviously rising rates are intended to sort of be a drag on the economy, but it's not an awful period of time. Because if you look at the past 8 rate hiking period since 1977. So basically over the course of the past 40-odd years, there's been 8 different periods where we've seen the Federal Reserve raise rates. Why? Well, because that's part of the economic cycle. There's been 7 recessions, 8 expansions, 8 different periods of rate hike. I mean, you get the point. There's a certain cycle to all of this. Interestingly, if you go from a period of time when those rate increases started to 1 year out, you'll find that over those 8 previous times, average return is close to about 13%. So there's definitely not quite reason to sort of throw in the towel completely if you're in an environment of raising interest rates. I want to give you 2 other statistics, and these 2 I think are equally important. First and foremost, if you look at midterm elections, in case you forgot, we got one coming up in about a month. The reality is that going back to 1942, in the every midterm period, meaning the year that immediately follows the midterm election, if you look back to 1942, every year it has produced a positive return, the average of which is about 15%. So some interesting data on midterm elections and what happens once you get through that threshold of that midterm election. Similarly, if you look at investor sentiment, and this is one that I kind of always like to look at because it tells you a little bit about how people are feeling. Well, guess what? With that big of a decline in the first 9 months of the year, right? The biggest decline that we've seen since 2002, so 20-year period of time. As you might well imagine, people are relatively negative. And in fact, investor sentiment at the lowest level that it has been since March of 2009. Well, if you check your market history books, you'll find that, wait a minute, March 2009, that was sort of the turning point of when the recovery began post-2008. So obviously, time will tell. We got some interesting stats, if you will. We'll see if investor sentiment in midterm elections continue to sort of be the turning points or the potential for turning points that we've seen certainly in previous years. So stay tuned on that. Clearly, it is a time where inflation is first and foremost, and it is certainly having an impact across the board. That's one of the reasons why this coming week, actually, we're going to be doing a sort of a meet and greet luncheon seminar at our office in Winter Park. You get to see our little expansion, and we've got a good-sized conference room with that expansion, so we're going to be doing a sort of a meet and greet. Haven't done one of those in a number of years because we were kind of cramped at the office, so hence that addition of the additional space. And so we're going to be doing a meet and greet, but more importantly, a conversation about how you fight inflation and how you deal with inflation as an investor. So we got some interesting stuff to be talking about. That luncheon seminar is, of course, open to everybody. But particularly, it is sort of a meet and greet, an opportunity. If you've always thought, hey, you know what, I listened to this Joel guy on the news, on the radio, on and off over the course of the past 20 plus years. Before that, it was his father-in-law, Jack Nelson. And you know what? I want to go and meet these guys, or I want to go and check out the rest of the team and just give an opportunity to kind of meet us and put a face with the name, if you will, or put a face with the voice on radio or on our podcast channels. And there is an opportunity for that. So the date is October 13th. So that's coming up this week. Let me just check my calendar as to what day of the week that in fact is. That's a Thursday. So that is coming up on Thursday. So hopefully you can make it. If you'd like to join us for that, then simply go to our website, nelsonfinancialplanning.com, or you can call the office 407-629-6477. That's how you can register for that event. Speaking of the website, of course, as you know, the radio program is also a podcast, one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice, because in that way you can find our program and know when it gets uploaded. We also upload different stuff throughout the week as well. So changing gears a little bit, we all know, as we've just discussed, 2022 has not been a particularly great year for the markets. Well, that translates into issues for pensions funds, but the worst on that may yet to come, because a lot of those pension funds, for example, the biggest one here in the state is the state of Florida pension fund that manages about $180 billion in its pension fund. A lot of those funds have yet to sort of price in the damage from the illiquid part of their portfolios. Private equity, real estate, things like that. It takes a while to get accurate pricing on that versus, say, 100 shares of Microsoft. So the decline in the private equity or liquid investment type side of things takes a while to price in. Well, part of that, though, combines with a trend that pension plans got more involved with that stuff, seeking additional return. So when we return, we're going to talk a little bit more about this topic and how it might very well impact your pension plan. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're talking about the potential impact that private equity and other similar illiquid investments are going to have on pension plans. See, when it comes to valuing those, it always takes time to value those and put those into how these pension plans have performed. And one of the things that we've raised over the course of the past few years here is the alarming trend of pension plans trying to capture a little bit more return, getting more and more involved in these types of more sophisticated types of investments that are not fully liquid, and for that matter, don't have any way of getting immediately priced. So it takes some time to get the actual value And once you do, particularly in a tough period of time, you may be surprised that the value is not what you think it is. So welcome to the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program also happens to be one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So, what are we talking about? Pension funds today manage about $5 trillion. So if you're a teacher, a firefighter, or a police officer, those types of folks that have those pensions, based upon how many years they work and those kinds of things, it's about $5 trillion of assets in there. The biggest of which in the state of Florida, of course, is the Florida retirement system. They have assets today of about $180 billion. So one of the larger ones, and actually kind of one of the ones that's actually run relatively decently in terms of the rates of returns. The assumption that the state of Florida makes, as with many pensions, is that they're going to ultimately achieve over time about a 7% return using a mix of stocks, bonds, and other stuff. Well, it's this other stuff that has particularly grown when you start talking about illiquid types of investments. As more and more pension funds have reached for return, the reality is that a large part of the return that you would typically get on the bond side just wasn't there because interest rates over the course of the past 10 years have been incredibly low. So bond yields and things like that really weren't generating the typical return that they were. And so what was then happening is a lot of these pension plans were starting to shift a little bit more into this private equity, liquid stuff, things like that. And in fact, just in the past 3 years, that amount has increased by over 60%. In 2018, there was about $300 billion in these kind of private equity, illiquid investments. Today, or at least in 2021, it was $480 billion. So a pretty dramatic increase as the folks at these pension funds, and state of Florida included, but really the entire landscape of pension funds has really increased this exposure so that these illiquid assets now account to somewhere around the neighborhood of 25% of all pension money. And the notion of that is so that they could close the gap in terms of return. But the problem is that you don't really know what the value is, and you can't really get out from under it quickly. So these are kind of hidden more so in pensions than ever before. And the reality is that the average pension fund, as of June 30th, just experienced a median return for public pension funds is down about 8%. That's just on the publicly traded side of things. That doesn't include sort of the impact of the illiquid stuff, the private equity stuff, which won't, in fact, be reflected for another 2 or 3 months. So you won't, to another 2 or 3 quarters. So you won't really know that and how that piece of the equation has performed. The reality is that what's the impact or what's the potential impact? Well, if you know how pensions work, if they don't generate the return that they think they were going to generate, one of two things is going to happen. They're going to have to change their benefits, or they're going to have to change how much money is coming into the plan. That's where it could potentially have a pretty significant impact on you. Much like what we saw when we saw in 2008, a lot of changes where, for example, state employees are having to contribute 3% of their own paycheck into the retirement system before they didn't have to do that. The reality is that those are the kinds of things that you could very easily see changing on how that plays out, particularly because a larger portion, and we were talking about this for I remember us talking about this even years ago on this program, raising concern about if it's fine if you own all this illiquid private equity, fancy stuff, things like that, when things are going well. But when things don't go well, then it only exacerbates the problem the other way. That's been our concern for quite some time now, as we saw these levels of illiquid investments, private equity investments, all of this stuff becoming more and more a part of those pension dollars. Remember, those pension dollars are intended to be very secure, if you will, because those pension dollars that are held by the institution are the ones that are intended to generate out that monthly check that you get when you get a pension from whoever it is that you're getting your pension from. So certainly something to be concerned about, aware about. Let's hope that the state of Florida in particular, obviously that's the biggest one here in the state, isn't quite so heavy on that, although it looks like by the numbers they might be, and that because that pricing, those valuations won't in fact show up until several months from now. And when that happens, then the potential impact is that there can be a change of benefits. Ask anybody who's retiring under the state now about what their COLA is. It used to be 3%. Now, if you're retiring today, it's like 1.5%. If you retire 15 years from now, it's 0. So those are some pretty significant potential impacts that can happen, and certainly an issue that folks need to be aware of, particularly if they have a pension of any sort, whether it's from the state of Florida or wherever. A lot of these pensions have leaned very heavily into some of this illiquid stuff that, as the valuations happen on that stuff over the course of the past 6 to 9 months, that's going to negatively impact the performance, requiring employers to perhaps put in more dollars or, in fact, tweak the benefits. So certainly something to be aware of on that, because it is a dramatic impact. Speaking of the state of Florida, we did a seminar actually this past week talking a little bit about the impact of inflation on state of Florida employees. And certainly, regardless of which part you look at under the Florida retirement system, whether it's the pension plan, whether it's DROP, or whether it's the investment plan, inflation has certainly taken a pretty healthy bite out of any of those three options, right? If you're in DROP at 1.3%, which is the interest rate that DROP money pays, well, that's nowhere near what inflation is. Similarly, as we were just saying, if you're on the pension, your COLA now 1.5%, that's not anywhere near a rate to keep up with inflation. And then on the investment plan side of things, the impact of inflation and higher interest rates obviously impacting the value of investments. So regardless of where you are on the Florida retirement system, for example, inflation clearly having an impact no matter what alternative you picked under that plan. So what can you do to help offset that? And that was sort of a point of the conversation that we were having with folks this past week. Actually, it was supposed to be the prior week, but the hurricane canceled it and moved it to last week. And we think it boils down to 3 or 4 different things that if you are a state employee, or for that matter, work for a company that has a pension, as you start to kind of wrap your hands around the potential impact of the calendar year in terms of the markets and in terms of how other illiquid types of investments have been performing, then you may wind up seeing some adjustments. So what can you do in anticipation of those? And we'll have some thoughts and ideas on that when we return from the break, along with a conversation about sort of the economic impact of Hurricane Ian. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So what are some of the things that you can do if you're receiving a pension or working for an employer that's going to provide you a pension? What are some of the things that you can do to help offset inflation and ultimately offset any potential changes that might happen to that pension, particularly as public pension funds are experiencing, just like everybody else, a pretty significant reduction in the value of the assets that they are managing, and then layer in on top the concept that we were talking about in the last segment, that much more of those dollars that have been invested are in more sophisticated, illiquid private equity kinds of things where, great, your returns can be high, but your losses can be high as well. So it's one of those things that kind of accelerates it both in good times, but also in bad times. So what are some of the things that you can do to maybe try and combat some of the potential changes, or more importantly, inflation? And we think it starts with making sure that you're also saving some money on your own accord, whether that's in a deferred comp, a 403B, or things like that. Your employer is going to have that as an option. It is very rare these days to see a public employer not having some kind of an additional mechanism where you, as the employee, can take your own money and put it into an investment. And when you're doing that, you're getting some tax savings, but more importantly, you're also boosting up a bucket of money that, at the end of the day, you could certainly wind up getting additional income or additional use of those dollars once you get to retirement. So it really does start with, how do you try and save a little bit more through your employer and through the options that they offer. Deferred comp, 403B, things like that are options that immediately spring to mind that would help that picture. Similarly, it's about maximizing Social Security. I know last week on the program, one of our fellow certified financial fiduciaries at Nelson Financial Planning, Rob Field, was hosting the program with Garrett. And so Rob is our local national Social Security advisor. Strategies to maximize out Social Security. That also becomes a big part of how you wind up fighting inflation. Paying off debt, that's always, I guess, regardless of whether you've got a pension or not. It's always a good idea to enter into retirement with as little to zero debt as possible. And then to also be thinking about in retirement, what are some of the tax-efficient retirement withdrawal strategies that you can do? Because you've really got to be aware of what the tax implications are as you use this money. Because look, if you wind up paying more in taxes, that means you're not getting less for yourself. So it's really important to kind of make sure that you're using a tax-efficient withdrawal strategy, really taking a look at where the income's coming from, what the tax implications are, and more importantly, ways to sort of minimize that. Actually doing a projected tax return is sort of the best way to do that. No, not a back of an envelope thing would maybe work, but if you want to do it accurately, it's important to take the data, run it through the tax return software, and actually have a result that you can look at. So certainly something to be thinking about. That's why we do it that way at the office at Nelson Financial Planning, where we're actually doing the actual tax preparation work for our clients. So, excuse me, those are some of the things that you can do to try and offset the impact of inflation. And of course, lastly, we're always a big proponent of this, making sure that you're minimizing as much as you can your investment costs. So some important things to be thinking about, and applies not just if you're getting a pension or expected to get a pension, or with an employer that promises a pension at the end of the day, but generally for everybody as well. So certainly some things to be thinking about. So let's shift some gears here in the last few minutes of this segment, because we want to talk about the economic impact that a storm like Hurricane Ian has. And it's clearly dramatic. I mean, the scenes coming out of South Florida are just unbelievable, coupled with loss of life, just a tragic event and a tragic natural disaster. And some of the early projections in terms of the economic impact we've started to see come out, and these come to us courtesy of the Wall Street Journal. Hurricane Ian likely to weigh on economic growth throughout the fourth quarter. Estimated losses, $25 to $40 billion. Those are just the insured losses. So tremendous amount of loss. In Florida alone, the storm could lower the state of Florida's economic output by about 6% in the third quarter, which effectively shaves about 0.3% from the nationwide economy for quarter three, and about 0.1% from the national GDP, state Florida, after all, is a pretty big state, for the fourth quarter. So clearly, as with most natural disasters, you see these sharp, short but sharp economic contractions, and then slowly over time, that economic activity gets added back in as you undergo the rebuilding and process. But it clearly is going to be putting some pressure on areas that are already under inflation pressure, right? The building materials and things like that are already up almost 11% year over year in terms of the cost. The labor, construction labor, that type of skilled labor is also up, the cost of it, by over 5% over the course of the past year. So that puts further pressure on kind of those costs, because there's a clear economic impact to any time you have this substantial amount of damage, this substantial amount of a storm. So some of the things to be thinking about, I guess, obviously, it is short-lived, so it doesn't have a permanency, if you will. Obviously, for the families that were impacted, dramatically lost their homes or lost loved ones, then that's a permanent impact. Economically, when you think about the rebuilding and things like that, those are where the demand is going to be. So as a consumer, we would leave you with a couple of thoughts on this matter. First and foremost, if you've got your little home improvement project that you've been kind of working along and, kind of moving along on, but it's not quite finished, I would encourage you to maybe get at least the materials to finish that here in the near term. Because clearly here in Florida, there's going to be a huge demand for plywood, for roofing materials, for all of those kinds of things, because you're going to have a huge demand in South Florida as those rebuilding efforts start. So number one, sort of look to get your whole hands on the material, because this will certainly crimp supply throughout the state of Florida of those building materials and related costs. Other thing as consumer, and I remember this from Katrina, I don't know if you remember this story or not, but if you're in the market to buy a used car, a used truck, a used vehicle, a used boat, a used RV, whatever the case may be, over the course of the next couple of months, be careful, because as we saw in Katrina, a lot of what was done there is they took the vehicles and boats and whatnot that had been damaged with the water, cleaned them up, put them into the used car market, used boat market, and then all of a sudden you wind up buying something that looks good, but at the end of the day is a bit of a lemon because it was sitting in water for, multiple days. So buyer beware, I guess, on that in terms of the used market. And so those would be the things to really think about in terms of the economic implications of Ian and how it directly impacts all of us here in the state of Florida. Well, that's it for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you liked the episode and want to listen to more, check us out on our website, nelsonfinancialplanning.com.